We're joined now by Sally Old, interest rate strategist from JP Morgan. Also, Stephen Nash from FIG Securities joining us in studio with me, Carson Scott. Also, Sally, can I start with you? Those European bank stress tests. I mean, look, over the weekend we saw European media scathing of these tests, questioning at length the credibility of them, and yet the markets seem to have just accepted them and move on. Do you think that's realistic when you consider the credibility issues?
Yeah, good morning, Brooke. Yeah, well, it's quite interesting because, you know, at JP Morgan, our view on those stress tests is that we were pretty disappointed at some of the underlying assumptions that were used to calibrate, you know, how robust the European banking system was. And, you know, there are some, certainly, I think, you know, at the very least, some pretty generous assumptions made about haircuts for some of the sovereign debt. And then so, you know, our view is that, you know, markets are, you know, while they've taken this sort of in their stride short term, that, you know, maybe over the medium term, it's not potentially going to be a particularly good outcome for risky markets. But having said that, I mean, I think what's sort of interesting is if you look back to the same time when we went through this process in the US, you know, back in 2009, where we did stress tests on the banking system, and without doubt they were more credible and they were, you know, more robust stress tests. But, you know, basically risky assets started to rally ahead of the stress test and continued to do so for, you know, a couple of weeks afterwards. So maybe the risk to that view that, you know, at some point risky markets are going to capitulate because we all think the tests are, you know, have been a waste of time, is that actually risky markets keep going, and it's sort of almost like the market has been working through a checklist of things that it was a little bit concerned about. So we've sort of done the Chinese slowdown story. We saw their GDP numbers the other week. We've done the US banking reform story that's been signed by Obama, and we've done the European bank stress test story. So sort of some of the uncertainties and question marks over all those issues are slowly dissipating, and maybe that in itself is, you know, enough just to give equity markets a little bit of a boost over the next couple of weeks.
Stephen Nash from FIG Securities, though, we can say that all of these broader issues are resolved, but then people get the time to start looking at some of the details, and with the stress tests, for example, you know, there's some great questions about that. Do you think we'll actually see downgrades on the way in terms of sovereign ratings, maybe Moody's and S&P to come in and make comment as well?
Yeah, I think the market, as we've said previously, I think, you know, I was asked what I thought, I think, a few weeks ago about these stress tests, and I think it's much the same as the Greek situation. Initially, there's one reaction, and then the market wants more. And I think over time the market will demand more, and I think they will get it. So I don't think this particular issue is really resolved yet. I think there's more to come, and over time we will get better information from the European regulators. I mean, there has been comment that, you know, that despite, you know, the assumptions that are involved there, they just weren't strict enough. Really, it's not a stress test. I suppose it's a mild discomfort test. That really doesn't fit the definition of a stress test.
Is it, in Greece's case, in fairness, though, so much about banks as it is about just pure ability to balance the budget and a real likelihood of default, and then who carries the can, and presumably it's Germany, and what that does to the world, you know, Europe's largest economy and its growth profile?
Well, I think that the European regulators have really ruled out the default scenario. I think that's probably reasonable, but there's more. I think there's more to come in the sense of alignment between the various agencies in terms of ratings.
So you don't think they will default?
I don't think so, no.
Right. Sally, do you think they will?
The view at JP Morgan is that the probability of a default is, you know, definitely less than 50%. But I guess, you know, and I think that's probably the right view in the near term, and you sort of get the sense that in Europe, policymakers have done enough to stop this happening in the near term, and that's clearly a positive for the banking system. You know, but if you were to say to me, you know, would you still hold that view 3 years from now? I'm not sure I'd be so positive on that.
Okay.
Yeah.
Okay. Then again, most politicians aren't around after 3 years, in fairness, so yeah, it would be someone else's headache.
Well, I think, you know, you've asked the question, is there a default? I think that's a good question, but I think what we've been emphasising over the last few months is really the growth implications of all these downgrades. The spillover has gone from the sovereign area into the banking system, and now we've had the stress tests, but I think there's probably more to come in this sense, and the effects on growth are the things to really watch.
And Sally, you've been quite bearish on US Treasury yields. I want to bring up that at this point as well. Are you still bearish?
Yeah, that's right. Our US rate strategy team is still saying that, look, despite the revision down of growth expectations and inflation expectations, yields just still look way too low in the US, in the sense that, you know, we for one as a house have pushed back our Fed tightening forecast until the end of 2011. But, you know, really, if you look at 2-year yields where they are sort of sub 60 basis points at the moment, I mean, they're basically pricing on the Fed on hold for the next two years at least, and we think that's maybe sort of overstating some of the issues there. So, you know, we do think, you know, should risky markets continue to rally and yields continue to rise, there probably is good risk reward in being short the 2-year sector in the US curve, and we still have a 3.85% target for 10-year Treasuries by year end.
So those auctions that are kicking off this week, if last week's lacklustre demand was anything to go by, who picks up the slack if they don't show an appetite for US debt? Stephen?
Look, I'm not as bearish on US rates. I think they're there for a reason. There has been a push out of expectations of a tightening. You know, the market's there. I mean, the 2-year notes are now below global financial crisis lows. People have effectively rolled out into the 5-year. There could be another roll out into the 10-year. I think, yes, you know, they do appear very low historically, but we've got a new situation here. I think other people have commented on the new normal.
It looks as if we're moving in, though, into the longer term. To pick up more yield, that's where the real interest will be, like in the 7-year over the 2-year. Is that a fair call?
Yeah.
Right.
Can I ask you as well, and we talked earlier, Sally mentioned, you know, these overall issues that we've got going for the markets at the moment, and the European Bank stress test was just one. We've had the US Reform Bill, or Financial Reform Act, and that's the Dodd-Frank Act.
Yeah.
I want to ask you, Stephen, because this is something we've kind of been following a little bit for a couple of weeks. Do you think the ratings agencies are actually going to notch down US banks when you consider the Dodd-Frank bill and what went on?
Well, it's a very interesting question. There has been astoundingly a lack of discussion on this point, in the sense that the US government is effectively withdrawing systemic support from the banking system. And it has been commented that there are quite a few notches involved in that support. We anticipate the rating agencies will take a very measured approach, and it will probably take a while for ratings revisions to occur, possibly 3 or more months. But at this stage, it looks as though there could be a possibility of some downward moves in US bank credit ratings as a result of this. There could be an argument that the withdrawal of the systemic support is going to be replaced by a stronger system. The banking system will be stronger, and I agree, in the medium term it will be stronger and the banks will be much better capitalised. But in the very short term, there is a possibility of lower ratings for US banks. Yeah.
Sally, is that something you guys have been looking at as well? Or
well,
have you got a response to that?
Yeah, I mean, I guess, you know, it's really only been sort of last week to have actually known what the final format of that bill looks like, and the timeline for implementation of that bill is, you know, reasonably long. So I suspect, as Stephen was saying, you know, if you think about it just in very broad terms, you know, if you're taking away basically the backstop to the financial system, that probably will involve some downgrades in ratings. And it's sort of interesting because, all other things equal, that implies higher funding costs for US banks, you know, which means system-wide the cost of credit will go up. Certainly in the US economy already more than it has done. So, you know, and that clearly has implications for the macro economy. So I think all these things, you know, are probably going to happen, but the time period over which it takes to play out is probably going to be maybe a little bit longer than a couple of months. Given some of the implications and ramifications of these downgrades for US banks and the economy as a whole.
The actual teeth, though, of this new bill, in theory, regulators have not just the right inside it, but the responsibility to act to break up an entity that's deemed now too big, so moving away from too big to fail. But no one's suggesting that you'd wake up one morning and see Gold and Man and Sachs. In other words, 3 entities versus the one behemoth, right? They're not going to do that. Come on.
No,
Not in a month of some days.
it's a good point, but one of the things that this bill does is that in the case of a stress situation, bondholders are in a situation where they really haven't had any precedent before. Now, it's important for bondholders to feel secure. Now, what has to be done, I suppose, is to walk bondholders through what would happen in a stressed situation. if you've got to look after anyone right now, it's bond holders.
And the problem is, Stephen, if you want to do that, you've got to have confidence in the regulators. But the regulators were asleep at the wheel last time. So why would you believe them this time?
Well, that's another point. There's a lot of things to be done, a lot of rules to be made and procedures to be drawn out.
But they said that last time and they didn't do them.
Yeah.
So, yeah. Rhetorical.
We do have to wrap up, but Sally, just to you to finish off, and ever so briefly if you can, we promised viewers we'd get your thoughts on the CPI number, so we have to do that. How are people positioning ahead of that tomorrow?
Yeah, look, I think broadly the market's been positioned for higher yields in the last couple of weeks, and that's sort of what we've got. So I suspect people have trimmed back their positions, probably a little bit neutral, wait and see what the number brings us tomorrow at 11:30, and then I think make a call on that heading into the August board meeting. So broadly neutral, but near term I think yields are probably going to continue to still go higher.
Thanks, Sally. Sally Old there from JP Morgan, and Stephen Nash. We didn't even get to get your view on CPI, but we'll chat soon. Thank you.
Thanks,
Stephen's from